G'day everyone, welcome back to this series on technical analysis, and this time we're going to be looking at support and resistance zones, how they occur, why they occur, and how to actually use them profitably in your trading. So let's jump in and have a look. The first point I want to make though is that you can make any part of technical analysis either quite simple and straightforward, or you can make it really quite complicated. Human tendency is to want to make it more complicated, to put more lines and squiggles and indicators on it, but I can tell you that that normally doesn't work too well because it ends up making it very tough to execute and a little confusing. So simple is always best. And in this video series on various technical analysis methods and indicators, you'll find that I always go for the really simple things because I find that they work really quite well. Now, we can construct support and resistance lines either on a horizontal basis or on an inclined basis, and we'll be having a look at a couple of charts in just a minute. But the key thing about how you construct those lines is that the more touch points that you've got along the highs and the lows of the price action, then the more valid that support and resistance line becomes. Now let's have a look at why they actually occur. And it's really just about human emotion and the way that people behave at extremes of the market. And also the market has a bit of a memory. Where prices have turned in the past, there will tend to be an impact at that level in the future. So let's have a look at a couple of examples to work through this. We're going to have a look at Wally Parsons, which is an Australian engineering company. Having a look at the Dow Jones index, which is really quite a fascinating setup, and also the German DAX index as well. So that'll give us a good look at constructing and using support and resistance levels. So we'll start first of all with Wally Parsons. And if you have a look on the right-hand side, the scale there runs from around $5 at the low to a peak of about $54 if you can't quite see it clearly. Now the stock ramped up to an extraordinary level from 2005 through to a peak right at the end of 2007. And you'll notice that along the way it went through, formed several peaks, and the price then pulled back from that peak, and then it took off again, rose, formed another peak, consolidated for a while, then rose again, pulled back. And each time that it does that, we can start to construct a level where there are various reversals of support and resistance occurring. So if we construct as a really clear line that developed here at around about the $30 mark, and we could start to construct that line certainly by around about March of 2008. So you'll notice here in May of 2007 that the price actually went up and down, fluctuating above and below that $30 level for quite a number of weeks. It then burst higher, came back and tested that level. It was a little bit of an overrun, but basically tested that level, found support. Now the reason that it finds support at that level is because there are people who were thinking about buying back here in May who didn't, and who have kind of vowed to themselves that the next time the price came back to $30, they'd be a buyer. So that creates a floor in the share price. So people bought on that level and pushed the price up to ridiculous levels, up above $50. That was always going to come back down again, and of course the GFC only served to make that sure that that happened. And the price tumbled all the way back down to $30, but lo and behold, again there was lots of support at that level, because people had remembered that that was a level of support, and it was a level that they wanted to buy at. And also you've now got technical analysts all around the world who are now drawing these lines and expecting to find support. So they're actually placing buy orders as well. So it was no surprise to see the price come back down to that level and then bounce very hard. And it bounced from $30 and got up to about $42. So that's it's about a 40% gain just in that few weeks there. Now the price then declined again, and lo and behold, $30, it bounced again for the same dynamic that has been occurring over the previous year or so. It happened a fourth time in September of 2008, and you'll notice that every time the market bounced, the peak that it formed was lower and lower. And then eventually the price basically broke through that level. Let's just tighten in here and have a little bit of a closer look at this area. So the price eventually broke through that area, and of course once it did, then the buying support just completely disintegrated, and the price just completely collapsed. In the space of a few weeks, it collapsed from $30, which had been a really important support line, and actually went down to $11. Now you'll notice then that over the next year or so, the price bounced back up to $30 at this point here. I'll just highlight that area. So the price bounced back up to $30, had a little bit of an overrun, got rejected, went back up again, got rejected again. So the people who were selling here were the people who were buying back here in 2008, who got caught and had to suffer through the price falling from $30 down to $11. So they've vowed to themselves that if the price gets back to 30, then they're going to be selling. So the price was unable to break through 30 and again fell away, came back down to $20, had another go at it, and there was a preliminary break, and this is what I call a false break. And false breaks are actually a terrific trading opportunity. It's where the price makes a bit of a breakout for a few weeks, but is unable to sustain it. And from there, the price basically has not been able to penetrate $30 again, even though it's tried on 1, 2, 3, 4 more occasions. So you can see that $30 support and resistance line is a massive memory in the market. There is a lot of activity around that level. Now, of course, the other way that we can look at this is to construct a trend line now around what is quite clearly a downtrend. If we construct these support and resistance lines, you can see on an inclined basis we've now got a trend channel, and the price is bouncing from the top of that channel down to the bottom of the channel. So that's a really, really graphic example of how to trade around those levels. Now look at this trading channel here in downtrend. So if you're looking at short selling this stock, for instance, at around this $30 level and then the subsequent lower levels of the channel, then you can put your stop loss exit just on the other side, and that means that you're risking very little to potentially make quite a lot, quite a number of times your risk. Let's turn now to the Dow Jones index, and this is a particularly interesting setup. We've had a support and resistance line, so there was a level here at around 15,600 on the Dow Jones. You can see that the price had gone up to it in May of 2013, again in August of 2013, in September of the same year, and then again spent several days here in November. So that was a key support level. Now the price eventually managed to break above that 15,600 level and ran up another 1,000 points before it fell back. Now it only just spent one day at that level. It did find a little bit of support for a brief period, but then has clearly broken through to the downside. So I would expect now, based on this chart setup, having broken such an important line of support and resistance, that this index will be highly likely to head further down. Of course, in the short term, it might rebound and retest this line, which is likely now to be a resistance line. So if that were to occur, then a good trading strategy would be to place a buying order just under that 15,600 level with a stop loss just on the other side. Now, one final one to finish off on, and that's the German DAX index, and we can construct an inclined trend channel on this one as well. So picking up all of those lows through there, there are quite a number of them, and we can also construct a line through the peaks as well, parallel to that first line, so that gives us a nice trend channel through there. And obviously we can trade the top and the bottom of that particular trend channel. So there are quite a few methods to trade around those levels. We can assume a reversal and use a tight stop loss, as I've indicated in those previous charts, so we don't necessarily need to wait for confirmation. Or we can actually wait for confirmation of the reversal, so we can wait for if it's a buying off the bottom of a support or a trend channel, then we would wait for a very positive upward candle. If we're looking to short sell the resistance or the top of the trend channel, then we can obviously be looking for a significant down candle as well. The false break I talked about, it's certainly one of the better trading setups, because what has happened in a false break is that everyone has gone to one side of the boat. In the case of a breakout, the one with Wally, everyone has run to the buy side of the boat, and then when it fails, you've basically got no one on the buy side, and everyone has to rush back to the other side of the boat, to the sell side. And generally what happens then is that you get quite a strong decline back into the range. So that's it on support and resistance lines. They're a simple tool, but they're very powerful in what they can do for you. Now, in future videos, I'm going to be looking at Bollinger Bands and how to trade them properly, and not many people know how to trade them properly. I'm going to be looking at relative strength index, and also going to look at Fibonacci retracement structures as well, which is a really, really important structure to use. It's a very robust tool to help improve trading results.